tonight is you guys are going to be in for a really, really amazing treat. So go to the participant if your friends or your colleague or your classmates or your students or anybody is not here. Make sure you send them a text or call them to tell them make sure that you are on because you do not want to miss it, right? My name is Odetta King. I am a senior marketing director with World Financial Group. We host these webinars, financial webinar every Wednesday. And April, did you guys know that April is Financial Literacy Month? Does anybody know?
Food on y'all don't cook.
Okay, let me mute the line. Marsha, I can hear you, honey. I'm happy you're here, but I'm gonna mute your line, Marsha. What you cooking? What you cooking? You cooking some curry chicken? You cooking some curry chicken, Marsha, or some cook up rice? What you got over there? Awesome. Thank you guys so much for joining. Yes, please mute the line because we have a jam-packed information session. So, as I was saying, my name is Odetta King. I am a senior marketing director with World Financial Group. Love, 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 love this campaign and mission that we're on to educate the community because I promise you, our people do not know this information. And if we were not into this business, we wouldn't even know this information, right? You're looking at a professor, you're looking at an author of 4 books. Playground Millionaire, showing you how to set your kids up to be millionaire tax free, right? Or yourself also tax free. This is why you're broke, right? Because if we do not know how money works, we're gonna be broke, even if we get $1 million, right? If you ain't stacking, you dropping. Guess what? You always got to be stacking these coins, honey. You always got to be making those money. And the fourth book, Let's Get Rich, right? Making sure that we know how money works. We have our budget, we have our strategies, we have our goals. We know what's going on with our money. We are controlling our money, and our money is not controlling us, right? So tonight, I'm super, super excited. We have an amazing guest speaker. And y'all, if you think April was crazy, May is about to be even crazier. We have a dynamite lineup of speakers that's going to be gracing the Zoom stage in this Money Mastery series. So make sure that you come back every Wednesday and make sure that you also invite people every Wednesday. And I see some popular faces. I'm just going to give a
I'm
shout
not
out.
letting nobody hurt you.
Oh, oh. Okay, let's do this right now. Mute all, mute all. Yes, guys, just mute your line. Um, so I do see a couple of faces. Well, not faces, because I can't see everybody because some of you have your camera off. But I'm gonna give a shout out to a couple of people that I see on Zoom. I know I see you guys have been coming every Wednesday, and that's good. You guys are student of the business. You love learning. Shout out to Colin Stevens. I see you. Thank you for always coming on. Shout out to Miss Diane Dobson. Let's see who else, or like the student that are always here. I just saw Marsha. Welcome, welcome. Sheldon is in the building. So happy to see you. Chimar is in the building. Solita Nunez, Sonia, Tanya. Wow. Tora. Hi, Tora. So happy I was able to meet you in person at our World Conference on Saturday. Thank you for being on. And we have Yolanda, who is an accountant. She's also in the house. Woo! Super excited. But let me stop getting excited and get to the main event tonight. Okay, we have we have one of the country top tax advisor. She comes all the way from Houston, Texas. So that's how you know this business is a big deal. I'm in New York, she's in Texas. By the way, where are you guys from? Put your city. Put your city. I'm gonna look at the comment. Put your city in the comment. I want to see where you guys are coming from, right? She is Colombian background, so all my Espanol chicas, right? If you Spanish, rep it, because this is your girl. Shout out to the Latinos, right? She is an accounting graduate. Yes, honey, from which university? Houston State University. So she knows she got those credentials. Okay, she is certified. Okay, from not just any college, but from a university. She is also a tax advisor. How many of y'all want to know how to keep more money in your pocket and not in Uncle Sam's pocket, right? She is a tax advisor for 13 years, honey, and running her own company since 2015. Myra is also a licensed advisor because somebody in WFG was running after her for years. And she's like, I'm so busy, I'm busy, I'm busy, I'm busy running my tax practice. I'm busy with all my clients. I ain't got no time with this little WFG, whatever y'all call yourself. But look who's doing the webinar today. Look who is crushing it in WFG today. Okay, all righty. So Myra is a licensed financial professional. Not only is she advising her tax clients, but now the girl is killing it. Now the girl got more ammunition. Now the girl got more knowledge. Now the girl got more information that she said to me, Odetta, I am so busy with my tax client. Like I haven't even like gone out and find new people. My tax client is who I'm helping with all this WFG financial work. God is good. Okay. So she has been advised helping people with filing their taxes, both business and individual in all 50 states. It's a big deal, honey. She knows it. She knows her stuff. Okay. She is also an enrolled agent in the IRS. When you and I are afraid of the IRS, homegirl is on the IRS and dealing with the IRS all day, every day because she is a licensed enrolled agent. So she knows what's happening in the industry, right? Myra started with WFG and her husband, guess what? June 2022, not even long ago. And since then, she has reached agency ownership. Now, if you're in WFG, right, you know how hard it is to get to agency ownership. That is a senior broker. She is a senior marketing director. She started this company with her husband June of 2022. So we're coming up on 2 years, right? And she already is a senior marketing director. She owns her agency and has crossed 250K. She slammed down 250K like in no time. She way past 250K now. I don't even know what her cash flow is, but God is good, right? And again, the mission is before the commission, right? So without further ado, I'm going to shut up and give the Zoom stage to Myra because even me, I'm going to be a student right now to learn how is it she is blazing the chart, how she is helping clients, and how is she going to help all of us understand how to win the money game from a tax perspective and why certain vehicle is the best. Oh my God, I just saw Lauren. Hi, Lauren. I see you. Lauren is from Georgia. Y'all, listen, I'm so loving all these people I'm seeing. So I'm getting excited. Let me stop and turn it over to Myra. Myra, take it away. And thank you so much. I know you're super busy. Thank you for being on today and sharing this information with all of us.
Thank you, Aldetta. Well, good night, everybody. Good evening, good afternoon, and wherever you're logging in from. And Aldetta, thank you so much for that intro. I don't even know what else to say. I mean, she killed it. She pretty much summarized my whole life. So, like Odetta said, I am a tax advisor out of Houston, and because of WFG, not only have I, connected with so many people outside of Texas, right, that I've been able to help people on the tax side in California and New York and New Jersey and Georgia. And honestly, I think that because God knows that I have a heart to help and I see opportunity, right? I specialize in identifying problems that people didn't even know they had and bringing a solution, bringing awareness to them. And that's what we want to do tonight. So tonight, we don't want to push a specific topic because this is better than that. We want you to understand the definition. We want you to understand financial literacy, right? Is knowledge. It's financial knowledge. And it's not financial focus on this because this is better than this. No, it's bringing you the knowledge, bringing you the awareness of what is out there, what exists, right? As far as cash value accumulation, retirement strategies, tax savings, and how everything ties together with taxes. I'm sure you guys have seen the memes that come out with, you mean I have to pay taxes on what I make, and then I got to pay taxes on the money that I spend, and then I gotta buy the property and then pay taxes on that property. So we're always paying taxes, 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 taxes. And recently, obviously tax season, for those of you that think it just ended, it never ends for me. It's year round. But honestly, this tax season has been very, very special, if I should say, because tax laws have changed. And what I noticed, and it's kind of sad, but what I noticed is out of all my clients, I saw a high increase of people withdrawing their retirement, okay, not knowing what the consequences were. Here's what happens. And I'll open up with this because I feel like stories and experiences and giving you an example is going to go much further than me showing you a bunch of slides and going through definitions. Okay? Because you might relate. This may have happened to you. And if what I'm going to say has happened to you at any point in time in your life, share your story in the chat. We're here as a family. We're here to help each other. A lot of people don't believe me when I tell them about the penalties and the taxes involved in having the wrong retirement account and then having to start over, right? Not knowing because nobody told you, because HR didn't sit down with you and explain to you everything that could happen to your retirement if you have a 401k, or your financial advisor set you up on a Roth IRA but maybe didn't explain to you what the consequences would be in the future. So the experience that I've had recently is that a lot of my tax clients, because they weren't aware, they withdrew money from their 401k or even from their IRAs or any type of investment accounts that they had. When they did that distribution, they got a check and their assumption is, oh my God, I got so much less. Surely the taxes have been paid, right? So when I met with a client, and I saw their 1099-R, which is what they give you, right, when you make a distribution from your retirement account. They're telling me, well, I already paid taxes on that. I have a client recently that withdrew $100,000 and they charged her $20,000. She's in her 60s. That was all the retirement she had. What is she going to do with $80,000 for the rest of her life? That's not much, right? Well, the sad thing is that when I did her taxes, and this is an example of somebody in their 60s, she's thinking, well, I shouldn't have to pay, penalties because of my age. And I said, that's right. You don't pay penalties. However, because you made this withdrawal and you receive Social Security benefits, the Social Security benefits that you received are now taxable. See, no one told her that. So here's a woman in her 60s that receives maybe $20,000 a year from Social Security. And now I have to tell her she owes the IRS and the state that she lives in, because they pay state taxes as well, a combined $17,000 in taxes. That broke my heart. How do I tell this woman that is barely making it, and this is all she has, that now she has to give up another portion out of the 20,000? The 20,000 wasn't enough. So these are the things that people just don't realize because they don't understand how taxes work, right? When you make any type of distribution out of your retirement, it gets added to any other income. So if your spouse works, even if you don't and you withdrew that amount, they're going to add it together, which is going to do what? It's going to increase your taxable income. Then you're going to say, oh my God, I have to pay taxes. I didn't know, I didn't even have this money saved. And now you're paying interest and penalties. So you see how there's a domino effect of problems. Why? Because they didn't know, because no one taught them about alternatives. No one explained to them, right? And that's what we're here for. That's what Odetta is here for. That's what every licensed agent that is on this call, that is why you have a license, right? This is why we go and share this information. This is why we share these workshops and we don't keep it to ourselves, but we bring the information to other people. And it means a lot to me. And I'm very grateful with WFG because of the resources and the platform that they've provided for me to help my clients. And yes, I've made very good money. Since I started, I just pulled up my total cash flow from June of 2022 to April of 2024. We've made $426,000 in commissions. Praise God. But you know what that means? That means there has been millions of dollars protected from market losses, millions of dollars out there for benefits for families. That means I helped a lot of families set up something that would protect their future. That's what that means, right? Because we don't get paid unless we're helping families. And I love that. I love that money is the consequence of us helping people. So with that being my opening statement, if you've ever had a situation where you've lost a lot of retirement savings, or you've had to lose to penalties and taxes, share it with us in the chat. I'm going to show you guys an example tonight. We're going to talk about what a Roth IRA is, because what we want to talk about tonight is tax-free strategies, right? And what most people will say is you got to do a Roth. You're going to hear a lot of things like buy term and invest the difference. But does anybody tell you why? Why buy term and invest the difference? Okay, and if I invest the difference in what? So there's a lot of information out there, right? But we got to understand the information so we can make the right decision and not just go with what my cousin or what my friend is doing. Because all of us, hey, our future, it's in our hands, not in someone else's to direct it for us. So it's up to us to make sure that we know these things and that we go and share it so that we can truly help people make the right choice. So one thing that I always tell my clients is wherever your money is, does it have the chance? Is there a risk of losing anything? Can you lose it to taxes? Can you lose it to penalties? And can you lose it to the market? If the answer is yes to any of those three, then we need to discuss your options because there's a problem with that. Ask those questions. Look at your own savings. Look at your own retirement. If you don't have anything, you definitely have to talk to someone because time is valuable. Time is literally money, right? You start today, you start saving today, money starts making money. You want to keep waiting, it's going to take more money because now you have less time. You have less money, so you have more time for it to grow and for money to make itself. But if you shorten that because you decided to wait, now you're in your 50s and you're looking at your retirement, and what is it going to take? Man, I'm going to have to start a side job, another bit. We're going to have to figure something out, right? And so this is the awareness we want to bring tonight. It's Financial Literacy Month for a reason, because there's information that we need to share with people and help them understand their options. Do not ever get out there to convince someone of an option, but educate them, right? So that they understand the options that they have. And now they're excited about what they're going to do and growing their money tax-free and all the benefits that come with it, right? It's like when you go out there to let's just say, just to give a world example, when you go buy a car and at the car dealership they're showing you this versus this, but now you got the one that, okay, this has all the bells and whistles, and I'm like, you get excited about it, right? You have that feeling of excitement. That's what people should have when they're thinking about their retirement. They shouldn't feel like, oh my God, oh, the market's not doing good. Oh my God, there's war. This is happening. What's going to happen to my retirement? There's already trauma from 2008. How many of you cringed when I said 2008? How many of you remember 2010? How many of you remember the market crashes? What happened in 2020? If you felt something like, oh my God, I remember, because I felt it. 2020, I lost $30,000 to Bitcoin because I was one of those. I put money in Bitcoin thinking, well, it's going to take off. Come 2021, boom, lost everything. It's 2024. I'm still waiting to make up my losses. Here's the thing. Time is valuable. I value my time. It means something. I am not willing to put my hard-earned money into an account that could possibly, even in the least bit, have the possibility to lose to something that I have no control over. Market crashes, you have no control over. War, you have no control over, right? And if your money's tied into something where it can crash because of that, you have a problem. And we want to help you find the solution. So I'm going to share my screen.
Wow, this
And
is so much value already. Guys, did you guys get the 3 questions she said we should ask? Did anybody write that down? Put it in the chat. Um, and while she's pulling it up, I just saw some more people enter the building. We have another tax advisor, my girl Judith Hamilton. Woo! So happy you can make it. Judith is going to be doing these webinars in a couple of months. She don't know, but I know. She don't know what I got in store for her. She's going to be right up here next to you, Myra, in a couple of months.
Awesome, awesome. We love tax advisors and I love to show them how they can help their clients. So if you guys, all of you that just got your taxes done, talk to your tax preparer and tell them this. Tell your CPA, your tax advisor, and they're busy people. Trust me, I know. But you want to tell them this. You want to tell them, can I show you a way that you could truly add more value to your book of business and helping your clients when tax season slows down, right? To show them something. One thing that as tax advisors we do, we're always looking for tax strategy to help our clients reduce their tax liability properly, right? And so when you're talking about doing that on an annual basis for anybody on here that does taxes, that's great. You help them for 1 year. You helped your client save taxes or get a bigger refund, whatever it is that you did. But that's a one-time thing. What about their future? What about their money, the money that they're putting away for their future? Are you helping them with that? Can you advise them, or are you sending them to a financial advisor? Right? We add more value to ourselves as tax advisors when we see the full picture. And when we see those 1099-Rs, I don't know about you, but I have a heart that I cry for my clients. When I see those forms or when they show me their statements and I look at their statements and I can't share any because I didn't have enough time to block out the names, but you guys have seen your own statements. And I have a business partner on here actually that her husband just lost money in a 401k and we're putting it into an annuity. So there's people out there that are losing money every day. And here I am as a tax advisor, in front of so many people every year that I could help, right? You got to have that heart to want to help them protect their money. Hey, I don't want to see you losing more money in the market. Hey, I don't want to see you paying taxes in the future. I'm helping you not pay taxes or helping, let me rephrase that. I'm helping you reduce your tax liability today. So let me help you reduce your tax liability for tomorrow because I care about you and your family, right? Let me help your family reduce their tax liability. Let me make sure you're protected. Let me make sure that if something happens to you, your business is protected. That is a tax advisor that truly cares for their clients. That's why I did WFG. That's why I added it to my service, to my book of business, to truly help the clients that I was serving. So I'm going to share my screen and make sure I can share. Okay, can you guys see this? Yes.
Yes, we can.
Okay, perfect. All right, so this is my company, and I say I go beyond taxes, right? Thanks to the platform and the amazing resources we have through World Financial Group, now I go beyond taxes because this is what I do. I work with so many providers to bring so many solutions to so many people, and this is what anybody on this call can do, right? I have a tax business and I saw value in it, but what I love about our company is that anybody can really do it that wants to learn, that wants to put that effort and say, I want to start a business to help people and help families understand what I didn't understand before. Because even I, as a tax advisor, didn't know a lot of the things that I learned through WFG. So in our platform, I now get to help my clients with all of this and more. So I won't go into detail with that, but this is why I love what we do. Here's the thing. We teach our clients, right? It's financial literacy month. So what do we teach? How does money work? Financial literacy, right? How does it grow? Through compound interest. How can you lose it? Through taxes, right? What's the other way you could lose it? If it can lose to the market. So I'm going to break these down very quickly. Compound interest, all you got to remember is this rule of 72. You divide 72 by the rate of return and it tells you how long it takes to double your money. So if I tell you I'm going to give you the highest rate of return, Odetta, 12%, wonderful. In 36 years, you'll have $640,000. But then comes Uncle Sam and says, well, Odetta, you placed all this money in a 401k. I want my cut. And in 30 years, we don't know what that cut's going to be. So here she is, like a lot of my clients today, paying 30 to 40% of that cut to Uncle Sam, right? And then here's the other option. I'm going to jump through tax later and tax advantage accounts because tonight I want to focus on the Roth IRA. Roth IRA is a tax advantage account. So let's say that her money grows to $640,000. If it did, it would be tax free. Emphasis on the word if it did. You know why? Because even though a Roth IRA is great because it's tax free withdrawals, it is limited. It is so limited that Bill Gates can't get it. Even I can't get it. I don't qualify for a Roth IRA. I make too much money. Praise God, I make too much money, but I cannot even get a Roth IRA if I wanted to. Why? Because it has income limitations, right? So can you truly serve a market that way? No. Now the market's limited. Can a financial advisor help a wealthy client put money in a Roth? No. So what does that tell you? What does that make you question? So if the rich people can't put money in a Roth, where do they put their money? Why do you think you see so many wealthy people do what? I guarantee you a few of you know these topics and you can drop it in the chat. What do you think wealthy people do with their money? How do they reinvest it? What do? Most of them either buy businesses and sell businesses. What is that? Taxable income. Why? Because it's a capital gain. They buy and sell property, right? What are they doing? They're forced to put their money in places where the money will grow, but no matter what, they will always pay taxes on the gains. That's what wealthy people have to do, right? So they have to do strategy, tax strategy, and that's what I'm a specialist in. So I want you to be confident in the knowledge that I'm sharing with you tonight because I am speaking to you from my heart and by experience. Not experience in WFG, real hands-on experience, tax returns, financial statements, banks that I work with, things that I have seen in the last 9 years that I've been helping people with their bookkeeping and financials and tax returns and state returns and loan packages and everything that I know how to do. That's why I do this business with so much passion because I've seen it firsthand. And I want you to feel that. I want you to understand that this is not just something I'm telling you. I'm telling you right now, this is real stuff that's happening out there and you could truly help people. So if a rich man can invest in a Roth IRA, what's the next best thing? And that's what I'm going to show you today. So as far as the investment options, right? Let's say it's someone who's, maybe 50,000 income, 30,000 income, whatever. And they're just saying, look, I want to save my money. I want it to grow tax free. Every TikTok video I see says Roth IRA because everybody's listening to TikTok and it's so frustrating, but it's the truth. It's the world that we live in. They get guided with social media, right? And you see, max out your Roth, max out your 401k. There is a reason why. I want you to understand this because I'm going to give you the answer. There is a reason why you are able to max out a 401k almost by 3 times higher than a Roth IRA. What do you think that reason is? Because 401ks get taxed when? Later. It benefits the government for you to put more money in a tax later account because who gets the cut? They do. So the limits of contributions for the tax advantage account with the Roth, it's very limited. Why? Because they get no cut. There's no partnership with Uncle Sam. So he prefers to not give you that cut. And that's just the truth. Now, as far as investment options go, you have something fixed, no growth, but it's safe. Then you have variable. This is where most people want to put their money right now because it's the trend. Stocks, cryptocurrency, Roth IRAs, 401ks, traditional IRAs, all these other retirement options are variable. What did I say in the beginning? The 3 questions. Is your money, your savings, your retirement, your investments, is it in a bucket that can lose to the market? Yes or no? If the answer is yes, that means that you have a variable account. Right here. What happens with a variable account? If the market goes down, then it comes back up. Market goes down, comes back up. So what happens in the time that it goes down to the time that it comes back up? You are making up your losses. Again, time is valuable. So if you're always catching up, makes it a little difficult, right, to keep getting more gains. So in an index account, you get the best of both worlds. Locked in, safe, growth, safe again, growth, safe again. You get the upside of the market and you don't have to worry about the downturn. You don't have to worry about the downside, right? And this is what people need to know. So going into tax-free retirement savings. Here are the basic points that everyone should know about a Roth. You should know this off the top of your head. Withdrawals are tax-free, but they're not penalty-free. Number one, what's the penalty? 10% if you're under the age of 59 and a half, okay? What happens though if you're over the age of 59 and a half and you withdraw your Roth IRA, but then you have Social Security and maybe other income? Even though it's tax-free, it is added to your taxable income. Why? Because now it's a total income. So the amount, let's say you withdraw $5,000 from your Roth, that amount itself, not taxable. However, if that amount makes your Social Security go over the limit, now you're paying taxes on your Social Security. This is what people don't understand. And this is what I have to deal with when they say, oh, but I already paid the taxes, or they took it out, or no, it still gets added on. And this is what they don't explain to you, because the people selling Roth IRAs, they're not tax strategists. They don't know this stuff. You can't even blame them. What's the next thing? The contributions to a Roth IRA, they're not tax deductible. Okay, why? Because the withdrawals are tax free. The other point, income is limited. And I'm going to show you a table that'll show you how much income you can have depending on your filing status. If you're single, married, head of household, etc. And the contributions. Right now in 2024, they raised the contribution to $7,000 from $6,500. This is for individuals that are under 50. So let's talk about that for a second. If you're on this call and you make over $100,000, do you really think that $6,000 a year or $7,000 a year maximum is enough for you to save towards retirement? Not really. If you talk to any investor, they're saving a minimum of 10% of their income, 10 to 15%, if not more. Investors want to save money because they believe that money should make itself. That's why they are investors. They don't work for money, they work for the money that's going to go make more money for them. There's no additional benefits to a Roth. It's not protected from market downturns. These are just facts, okay? Is a Roth IRA a better alternative to a 401k? I would say yes, depending on other factors, if you're getting a match, if you're not, or if your company offers a Roth 401k, and those are more details that we can get into later. But as far as a Roth IRA goes, to keep things simple, is it a better option than a 401k? Yes, it is. Why? Because you'll have tax-free distributions. However, there's all these other little limitations that we can't ignore. This is why we're teaching this tonight. It's not a bad product. It's a great product. It grows tax-free. But we need to be aware of the limits, right? And the disadvantages that it has, just like anything else. So here are the contribution limit changes that they just did from 22 to 23. For Roth IRA contribution limits, it went up from 6,000 to 6,500. It's now at 7,000. But I want you to notice this. In 2022, 401k contributions went up from $20,000 to $22,000. For 2024, it's changing again. It's going up. But you see the difference between this and this? $22,000. Why does our government let us contribute so much to a 401k? Because they want to tax you on it. That's why. Of course they want you to contribute more, because the more it grows, the better for them. Why? Because when you're contributing to a 401k, you're not paying taxes on the seed, right? But you're going to pay taxes on the harvest. It's all going to come back, and it ends up backfiring a lot of people. And most clients that I have tap into their 401k way before retirement. And recently I have seen them literally have to take everything out and pretty much start over from zero. And that breaks my heart, because now all that time they just lost and now they have to start again. So these are the things that we want to bring to light, right? If you have a 401k, if you have an IRA, can it lose to the market? Yes. If you have had a 401k and you've lost to the market, put a 1 in the chat. If you've ever, or if you know someone, right? I know I'm not the only one that knows people. So then there's other retirement options, and you see here 457Bs, if any of you has that, traditional IRAs, Roth IRAs, SEPs, Simples, HSA plans. There's all these contribution limits because they all have to do, you know, in one way or form with taxes. Now let's talk about the income limits. The Roth IRA contribution rules for last year is this right here. If you're single or if you're head of household, you got to make less than 138,000, right? And you can only contribute up to 7,000 for 2024. If you make between 138 to 153, you can still contribute, but it's a reduced amount. And if you make more than 153,000, you cannot contribute to a Roth IRA. So what does that do? It brings up a smaller market, right? Because if you know people that, you know, are out there and they're making more money, if I'm making $400,000, 200,000 a year, my 1099 from WFG just for 2023 was $270,000. I can't contribute to any of this, right? And so married filing jointly, what is it? 218 up to the limit. So what does this mean? This means there's limitations. Not everybody can have a Roth IRA. Why? Because it's limited. So can a rich man have it? No, they can't. So we're going to talk about a rich man's Roth. What compares to this? Here's another example of the traditional IRA tax deduction limits. So traditional IRAs, when you contribute to a traditional, there is a retirement savings credit. There is a tax deduction because traditional IRAs are taxable. But again, there's limits. There's income limitations to that as well. So as we're going through this, we're realizing that things are changing, right? And a lot of you have seen this before. There's a reason why we want to share this information. Retirement strategies are changing. 401k is no longer the go-to, but it's where the government wants you to put more money in. Why? Because it's taxable later. These are simple terms. And I'm talking to you by experience because I really want you to remember this, not to remember all the technicalities, but just speak from the heart, right? Just by experience. That's how people listen, if they understand. So here's the rich man's Roth. Rich man's Roth is a strategy that we have through one of our product providers that acts pretty much almost the same way as a Roth, meaning growing tax-free with a cap return with Transamerica. So earlier we said 72 divided by 12, money doubles in 6 years. We have a cap of 13%. There is no market losses, and I'm going to show you an illustration how to compare a Roth to an IUL. No market losses, tax advantage, and there's additional benefits. Roth IRA does not have additional benefits. So I'm going to get out of this and I want to show you guys. I'm not going to go into that piece, but all right. So here's an example. I'm going to show you guys two things. We use a website called MoneyChimp to set up Roth IRA calculations. So I want to show you something right here. I'm 34 years old. The expected return rate, this is what the system gives me. On a Roth IRA, this is what the system gives me, a 5% return. You'll see a lot of social media videos, TikTok videos that say, oh, Roth average is 8%. That is not true. In fact, there's information out there, and I even found it here with MoneyChimp that explains to you why. There's a problem with talking about average investment returns, that there's real ambiguity about what people mean by average. So here, the system actually calculates the geometric mean, the compound annual growth rate, which is the more accurate growth rate for a Roth IRA. The main difference that we see in a Roth IRA is that it's exposed to market crashes. Is it guaranteed by the market? No. If you withdraw it early, is there a penalty? Yes. So is there a chance that you can lose your money? Yes. What were the 3 questions? Can you lose it if you withdraw it early? Do you have to pay taxes on it? And is it exposed to market risk? Those are the 3 things that I always ask my clients. So the compound annual growth rate, the real one, It's smaller. Why? Because the market's volatile. The market can go up or down. So here I put in date range the last 20 years, adjusted for inflation. The average return is 7%, but the true return, 5.6. Okay. And here's the thing, you know why? 2023 return was 20%. 2022 negative 24%. So what do you think happened? This is using S&P 500. So what do you think happened if the S&P 500 dropped by 24% in 2022 for people that had their money in there? They lost it. And in 2023, did they gain it all back? No, they're only up 20%. So that means they're still down. Do y'all follow me here? With the way the market goes up and down? That's what a Roth IRA does. It has that risk of going up and down. So when we're going back here to take the average expected return of 5%, if I was to contribute $7,000 a year until the age of 50 and then $8,000 a year until 65, then the withdrawal over the next 30 years would be this. At age 65, my account balance would be $542,000, and I'll be able to withdraw $33,000 a year for 30 years. What's the problem with this picture? It's taking an expected return rate, but we really don't know what's going to happen. Why? Because the picture is not really considering future market losses or how long it'll take to come back from that. So I hope I'm not losing you guys. If you guys have any questions, please put them in the chat because I will be answering some questions here shortly. So this is the comparison. Now, the beautiful thing about this, and it even tells you here, is that it's a tax-free growth. But look at what they say. Also see the risky retirement calculator to see how market volatility and inflation can affect your results. Because it's not all black and white, right? Why? Because they know they can't make any guarantees. They have to put this. And this is true for anybody that's in financial advising that has to make estimated calculations for retirement for anyone that has a Roth IRA. Yes, it's tax-free, but that's not the only thing that matters. All the other factors matter too. What if maybe today you make 100,000 and tomorrow you're making 300? Well, that's a blessing. But now what are you going to do? You can't contribute to a Roth unless you're planning on making less than 100 and something thousand a year. I'm not. So this is actually really good for you guys to consider, you know, does my retirement account match my vision for my life? Does my retirement account match with my future goals? Because I have a goal to be the first millionaire in my family, right? My kids will be millionaires in our family, right? I'm very determined to teach them and to show them, and I'm confident enough to know that I'm building a business that will be $1 million business. And I say that without a doubt. The Bible says to speak in faith with no doubt, absolutely no doubt. And you say to this mountain, move, and it'll move. And I firmly believe that. But you got to speak without a doubt. So now that you saw the Roth IRA estimates, I see these wings here, man. Those look good too. All right, let me show you guys this. Here's an illustration. This is me comparing apples to apples. Now, let's talk about just the money part, and then I'll go into the other benefits so everybody can understand. If I do the same thing, the same exact thing that the Roth IRA calculator just showed us, 7,000 a year, you guys see this here, right? It's 7,000 a year, age 35, and from it's first year, 34 to 35, and then going to age 65, at age 50, right? I put the system to put 8,000, right? Okay, so 8,000 a year at age 50 to age 65, I stop. I've made total contributions of $232,000. It's the same as the Roth example, but look at my value, $564,000. Is it tax-free like the Roth? Absolutely, 100% tax-free. What's the main difference? For me, I have $1 million benefit for my family. Not just 564,000. My own retirement account tripled almost, more than tripled. I put in $232,000 and I'm leaving my family with $1 million. Is the Roth doing that for you? I don't think so.
Wait a minute, I'm getting excited here. So the Roth yield how much in the same time frame? What was the amount that the Roth yield? And guys, pay attention.
It
This
was
is
$542,000.
542 with an annual payout of 33,000.
33.
Pay attention, guys. You're missing the boat if you don't see what's going on here. Pay attention, because
There's an
it's crazy. This is it. This is the meat and potato.
so
542.
so here's the other
30,000.
point that I want to make. Odetta, do you really think that in 30 years I can live off of $33,000 a year?
Hell no. I'm gonna be walking around Pat Mark looking for cat food. Like, I'm still gonna be on a budget. Okay.
Yeah, let's just be honest, right? Let's face the truth, man. That's what we're here for.
We still gonna
Can
be
I
broke.
truly live off of $30,000 a year?
We're still gonna be broke. Like, we're still gonna be broke in our 60s.
No. Right now, I make over 200,000. How the heck am I gonna go from 200? How am I gonna downgrade just because I'm older? I'm trying to travel to Europe with my husband. Like, I'm trying to do stuff when I'm older, right?
You're
And
trying to hang out with the grandkids, go on some cruise and do all these amazing things, but you're not gonna leave your city with 33,000. You're gonna stay home.
yeah, our property taxes in Texas, we've been blessed with a beautiful home, but we're not blessed with the property taxes. It's $20,000 a year.
Girl,
That's
you ain't
not
going
even
nowhere.
enough.
You
I'm gonna have to
gonna
sell my house.
you gonna go from your bedroom to the kitchen to the living room. That's where you're going.
So, first of all, we also have to be realistic, with talking about retirement. Like, ask that to the people you know. Ask yourself that. What are you putting away today? And what you're putting it away, is it matching what you think you're going to take out of retirement in the future? Because that means we got sacrifices to make. Either you got to cut back or you got to make more. One of the two has to happen. I decided to make more with WFG. That's what I did. Because I didn't want to cut back. I like my lifestyle. So let me show you guys something that's very important. Not only do we have to be realistic, in 30 years, I'm not going to live off of $33,000. So what happens with the Roth IRA is that I'm still limited. That even if my financial advisor said, well, you need $1 million to retire, well, can I do it with a Roth? No. Why? I make too much money, right? And I can't contribute more than this. So I'm limited. Now, why do I say this is the rich man's Roth? Because let's just say that I decide, well, before I go into that, because I'm going to show you guys the difference of putting in more. Now, the flexibility of our index universal account, right? The flexibility of having a cash value account tied to an index, because that's what this is, with the added benefit of protection, critical illness, chronic illness, terminal illness. Why would I question making a $7,000 annual contribution to a Roth versus a $7,000 annual contribution to an index account with all those added benefits? Be honest with me. Why would you question that? Right? If it makes sense. So if it makes sense, that's what I'm going to do. I'm going to go with my life insurance policy. Now, here's the deal, that if we're at 564,000 and the annual withdrawal, you guys saw it said 33,000. In this account, I can withdraw $55,000 a year. I can withdraw 55,000. And I want you to see something. This right here, you see withdrawals? In our company, what our index accounts allow us to do is withdraw what we put in first, tax-free, and then we borrow, quote unquote, at a 0% interest, the rest of our money. Why do we want to borrow from it? Because whatever's left in there is still generating interest. And guess what? Now you retire off your interest that you've gained in your account. It's a beautiful thing. It's a beautiful thing to retire and make money off your money. That's awesome. So right here, at the age of 70, now I'm borrowing. Now I'm tapping into my gains. So right here, all my money has been given back to me. So here's the beautiful thing. I saved for 30 years for my future, and my future paid me back my money in 5 years plus interest. So if I continue to go here, okay, 55,000, 55,000, 55,000, right? What happens during this time? There's still a benefit. If I die, my family still receives income. I love that. You can't do that in a Roth. There's no price for that. So here's the deal. This isn't my scenario. Now, let's say that, I'm building this up and I say, well, I'm going to keep making more money. And what I want to do is I want to double my savings over time. We have flexibility to do that. You can't do that in a Roth, right? There's limits. And is it flexible? Not really, right? Not really. Can you access it? Can you take out Roth money? Yes, but you're going to lose 10% in penalties if you take it out early. So let's just say that for the first 5 years, I do 7,000 in contributions. But because I'm doing so well in my business, I decide to double that, right? And I'm going to go from years 6 to 10. And then I decide to double that again. Let me see here. Actually, let's just keep it the same. I'm gonna keep it the same, but I'm only gonna do it for 15 years. I'm not gonna double my savings. I'm gonna double up my time, and I'll show you guys what that means. So the flexibility of what we do allows us to do what? Put in more money into our rich man's Roth and withdraw more money when we want to withdraw more money, and stop making contributions when we decide to stop making contributions so our money can just grow. So here, what I've done is, you know what? I don't want to pay for all this time. I'm just going to do 7,000 for now. And I'm going to start contributing 14,000 in the future because I'm going to make more money, right? Now, my retirement goals, my income goals, it's all climbing up together. So at the age of 49, I decide no more, not putting anything in. So come to the age of 65, what do I have? More. How do I have more when I put in less? Because of time. Remember what I said, time is valuable. You are literally wasting money when you're wasting time. And I hope this example shows you that. So $175,000 versus the $232,000 that you saw earlier, right? But what do I have as my surrender value? $604,000. Now I have more cash, less money, less time because I was disciplined, because I knew what I wanted. I knew that I did not want to keep paying for the, imagine if I do keep paying, I'll end up with $1 million retirement. That flexibility, you can't get that in a traditional Roth IRA. I'm sorry, a traditional IRA or a Roth IRA, right? And if I decided to max out, if I decided, well, I want to max out my 401k, like how people tell me, okay, well, it's very simple. Here, and I know I went through this pretty quickly. But before I go back, let me show you guys something too. If I wanted to tap into the Roth IRA, let's say in 10 years, I've contributed 105,000 and I have $121,000 available to me. And I need this. Maybe I'm going to buy a property. You know what I do? I teach clients, if you do this, save up the money. You want to buy real estate? Use your own money to go put down on a house. Don't use the bank's money. Then sell the house, flip it, take the gains and put it back into your account and let it grow again. There's so many ways that we can use this account because it's flexible. So if I have $120,000 gain right here, I'm sorry, $120,000 balance, and I can tap into it, I can tap into 117, no penalties, no interest. But if something happens to me, there is a big chunk of change that I'm leaving behind for my family, even from day one. See, if I put 7,000 in a Roth IRA today and I die tomorrow, my family gets $7,000. But if I put $7,000 in my rich man's Roth, in my IUL, my index universal life policy today, my husband receives $500,000 with my kids. You can't beat that. So going back here, as you can see that there's more money, I can start taking this out at any given time. You cannot do that in a Roth. You'll be subject to penalties. So that was the other thing. And then lastly, if I decide, well, I could just max out my 401k and maybe do something with that. Well, you could do that here. Let's say I did the maximum 401k for 7 years and didn't contribute anything else. And just for 7 years, I decided I'm going to do this and I'm just going to let it ride and let the money make itself. And I'm not going to make any other contributions. Well, can I do that? Am I able to do that? Right? You can. Again, it's flexibility. And every policy is structured and designed according to age, according to a lot of other factors, right? But we want to show you the main idea. If I do that at my age right now, if I max out my IUL, right, instead of my 401k, I'll max out my tax-free cash value vehicle. That's what this is. This is your tax-free cash value vehicle. I don't want to call it tax-free retirement anymore. You know why? Because I don't have to use it for retirement. I could use it for whatever the heck I want. I could retire sooner. I could use it for my vacations. I could use it to just take time off work and say, you know what? I have enough cash value in my account. I can retire when I'm 45. I don't care, right? Who does it depend on? Me. Depends on how I use it and how I structure my own account. So right here, 22,000 a year for 7 years. In 7 years, I put in 157. Look at what I have access to. $178,000. I would much rather max out my own tax-free cash value account than any 401k. I don't care about the stupid tax deduction, pre-tax, whatever. They're gonna tax me anyways later. So I'd rather keep it all tax-free. This is, to me, it's like having your cake and eating it too. Like you got it all. You put in your contributions, you're taking it out tax-free. So what happens at retirement age? At 65, $738,000. You see the power of time. The time that you have is so valuable. Why? Because I started sooner, I put in more faster. Now, no more contributions right here, 157,000 total. And at 65, I don't have 540, I don't have 560, I don't have 600. I have 738,000 tax-free dollars and a $1.2 million benefit amount if something happens before I touch that money. I don't know anything else that could be better than this. And as someone who has seen it all, I'm here to tell you that I haven't seen anything like this until I came to WFG. And I'm very proud to offer this to my clients. So lastly, the benefits, the living benefits. I mean, you guys, Transamerica is a solid company and our products, top notch. But here's the other thing. What happens if you have $700,000 in a 401k or a Roth IRA and you have major medical problems? You're going to have to go through all of your savings, right, to cover your living expenses. Is that fair to your family? Is that fair for all the years of work that we have? No. But here we have access immediately to our total benefit amount, $500,000 that I started with for chronic illness, critical illness, heart attack, stroke, right? Cancer, blindness. All these benefits, these are those other advantages that you get to have in an index account with cash value accumulation. So with all that being said, I want to answer questions and you guys can, if anybody wants to ask anything, Odetta, if you want to ask anything, or if I left anything out that you want me to touch base
Oh
on.
my God. Listen, I was just like, wow, guys. I mean, even though I know this stuff, I teach it, I preach it, we have these strategies for ourselves. Myra has these strategies for herself. All her kids have it, her husband have it. Listen, we're not telling you to get something that we don't have. We own these things ourselves. So, yes, put all the questions in the chat. I'm going to go through the chat right now, right? So just put your questions in the chat. I'm going to start from the top, come all the way down to the bottom. So some FAQs, right? So someone asked, let's see. Yes, you can use it to become your own bank, right? I love that Myra said, we're no longer going to call it tax-free retirement because this money can be used for anything. I designed these plans for babies, right? If they're 2 weeks old, they got their social. We setting them up for a lifetime of nothing but more money than they don't even know what to do with, right? So it's not only about retirement money, it's money to do whatever. It could be money for retirement, it could be money for college, it could be money for real estate, it could be money for start a business. And I love that I'm going to start saying that too. Tax-free cash value, because I don't have to retire to use this money. I could decide I want to go to Dubai tomorrow and pull out some money and go on my vacation, right? So it can be used for anything and everything. Is your money, let's see. Oh, someone asked, what is this account called? So it is called an index universal life, right? Do not get this mistaken with index fund, which are mutual funds, right? That would be variable, where your money's going to go up and down, where you're going to pay taxes and you're going to lose money. Not index fund. This is an index universal life that is a life insurance contract. Totally different from index fund, right? Index fund, you play with the stock market, you with mutual funds. Good luck with all that. It's good, but this is a different strategy. Someone asked Marsha, hey, Marsha, if you were listening to me, I'm going to call you out now, Marsha. If you were listening to me, you would know, because Marsha, guys, Marsha's a very good friend of mine. She's Guyanese. Whoop, whoop. And her mom and my mom are like bestie. And then, of course, her mom, I recruited her mom to this business. God bless the dead, Miss Brenda, right? And Miss Brenda and me used to be all over Brooklyn at where I had my office back in East New York. Then I had an office in Flatbush, and she would actually come and sit in on these sessions. And she's like, Odetta, I want to do this for Maricas, which is Marsha, who's on this line right now. I want to do this for Maricas. And we open up an IUL for Marika, right? Marcus, which is Marsha's son. So Marsha, if you do not know, that's because you weren't paying attention. Your mom set this up for your son. And I vividly remember driving, coming to your apartment to have you sign, right? To have you sign some documents. But of course, you didn't know what your mom was doing. But now you know, right? She made sure she set up Maricus, and God bless the dead. And Miss Brenda passed away. And last year, actually, it's coming up 1 year anniversary. Last year, when I went to the funeral, I went up to this little kid who I had never met in my life before, because I would always hear her talk about her grandson, her grandson. And I went up to him and I said, you know what? You don't know me, but your grandmother loved you so much that she put things in place to set you up. So he still have his account, right? He got his IUL, and he don't even know what's going on. Marsha, how old is your son now? So Marsha, you and I will definitely be talking, because this is what your son has, that you, God bless his dad, your mom set up for him, which now you're gonna have the privilege to continue funding the account and making sure that her legacy doesn't fall by the wayside, and you're also gonna get it. So she asked, at 50, can I still invest? I'm gonna keep my peace. What do you think, Myra? Can somebody still get an IUL at age 50?
Well, you guys got to think about this. For those of you that are in the older age sector, you got to think, this is why I said time is so important. So if you have less time, what you're going to have is more money. So what I did for a client of mine recently, they're an older couple, and what they have is they have income coming in from other sources, and they're basically taking that income and reinvesting it into an IUL. They're healthy, so it made sense for them. So for those of you, in that age range, it could make sense or it could not. Why? Because the older you are, the cost of insurance is higher. And so you don't want to put a lot of life insurance into your IUL if the purpose of it is for you to accumulate value. Now think about it like this. If you're between, let's say, the ages of 50 or 60, and you're healthy and you get approved, there is ways to design and structure your account where not only can you start saving money or putting money away, but you got to really think about it at this point. You're making sure that you're protecting your funds to leave an inheritance behind. So here's how my grandmother explained it to me, because my grandmother, whenever I started doing this, she's in her 70s. She was like, I need to do whatever it takes. And I said, why? She said, because I need to leave y'all something. I didn't do it in all these years, and the least I could do is pay a fraction of it so you guys could get the benefit. So she saw it as a future benefit to her grandkids, right? So it just depends. You want to get with the person who invited you and make sure that you connect with someone who knows how to strategize that correctly, because it does not work for everyone, especially if there's a lot of health issues, if the age, the health issues, it's not going to make financial sense. That's why earlier I said this depends on other factors. It may not work for everyone, but if you're in your 50s or 60s and you want to use this for retirement purposes or for cash value accumulation, what other options I've seen is I had another client open a funding account for his 18-year-old grandkid, and he's the owner. So he pays for the policy, he puts his savings into the policy, the insured is the grandchild. And so there, like I said, there's different strategies, there's different ways to go around it to make sure that it makes financial sense for your money. Remember, we're here to protect your money, protect it from the market, make sure that it grows. We want it to make sense. I see somebody asked about if this is FDIC insured. So let's talk about that for a second. FDIC is a federal commission that, protects your deposits from the bank, right? If the bank goes insolvent, the total deposits protected is up to $250,000. In Silicon Valley, there was a bank that totally went bankrupt, right? And a lot of people lost a lot of money because there was a lot of millionaires, and there's still a case pending there. What happens is the federal government will protect up to $250,000 of your deposits. Okay. With insurance, there's two things that are very important for everyone to know. For every dollar of an insurance premium that you give an insurance company, they have to show the government that they have $3 to back it up. They have to prove that they will not go insolvent, right? So number one, your money is way safer with an insurance company than it is at any stock account, any bank, because they don't have to prove anything to the government. So with an insurance company, your money is literally insured, not only by the company itself, but in your state, there's something called a guarantee association. And I'm going to share my screen so you guys can see this is a real thing for those of you that didn't know, even some agents. If you ever get this question, this is way better. FDIC insures your money from bank losses. Guarantee associations, every state has one. In Texas, it's the Texas Guarantee Association. So these associations cover major insurance companies. Transamerica is part of it. Nationwide is a part of it. They are all part of these guarantee associations. What this means is that if your insurance company fails, the guarantee association will protect you from not getting your claim paid out. Okay. And there's different limits, just like FDIC has 250,000 for the Texas Guarantee Associations. They guarantee, the state backs it up, and they guarantee $300,000 of a death benefit if the company was to go insolvent, or up to $100,000 of any money you contributed so you don't lose your money. So that gets protected. If you want to ask me about Roth and if that's protected, negative, zero. 401k, is that protected? No, you can literally lose everything overnight and no one has to explain to you what to do. Stocks, are they protected? Are they FDIC insured? No, they're not. So I would be more concerned on, is my money growing and can I lose to the market, and is it with a solid company? But if you wanted to know if there's a backup just in case a company goes insolvent, there is in your state. And this is the ACLI, Insurance Guarantee Associations. What is a guarantee? What is it? How does it protect the policyholders? And then here's an example of some of the statutory limits on claims. 300,000 life insurance, 100,000 net cash values, 250 in annuity benefits, including cash surrender, 300,000 long-term care, and 300,000 disability income. So the state protects you no matter what. But companies like Nationwide and Transamerica, let's be honest, they've been around for so long. I highly doubt that they're going to go insolvent anytime soon. But just in case, there is some type of protection. So I hope I answered that.
And I do
And
want to add, here's another website, right? This is a public website, is called usbanklocations.com. So if you're wondering, well, is this FDIC? Well, your money's already there, right? Look at all these banks that have billions of dollars and trillions of dollars in life insurance. right?
Yeah.
Your money's already there. What are you putting it or not? Indirectly, when you put your money with Bank of America, they got it,
Yeah.
right?
All
So
right.
life
Any
insurance
other
is the real
questions?
deal.
Let me see. All right, guys. Any questions? Any tax questions? I'm gonna call on one of my partners here because we just went over this. We're not doing this tonight, but you guys got to get with your trainer and ask them about index annuities. If you have money sitting in a Roth, a 401k, and you need to roll it over into something else, we have that for you, and we're gonna make your money grow. So Lida, I'm gonna spotlight you for just a second. I'm just gonna ask you a few questions, okay? Um, how much money did your husband have in his IRA and 401k that we talked about a couple months ago? Just a couple months ago. It was what, November, December?
So November, he had 125
Okay, and then it dropped
to
to
90.
90, and then now it came back up to 101, or what is
So
it?
we were what is it, a week ago? We were at 105 something, and then we went back to 100, like
Okay,
in a couple days.
and how did that make you feel?
I was like, yay, we're going up. And then it's like, oh no, we're going down. So yes, not good. The feeling is not good. The fact that you see your money just going away to thin air.
Yeah, and realistically speaking, do you really think that account's gonna come back up to 120 this year?
Absolutely not.
So what are you doing now in order to protect your husband's retirement? And it's not much, you know, he's still young. So we have your husband is 48?
Correct.
48, okay. So we have
So
some time to
yeah,
build
we
that
have
back
some
up.
time. And with the help of Myra, we have been looking into annuities. And as she mentioned, there's different options that you have to look at because we have, some amazing things. In the other sense, the IUL, like she mentioned, there's things that sometimes you don't get approved and sometimes like that. So, but with that, we're switching it over to an annuity. And now it's looking to see which one best fits him, with the fact, like we're saying, age wise, time wise, what fits better. Is there a bonus? Is there, which one has the highest growth, indexes and stuff like that. So I think it's just a matter of looking, but definitely.
Do you feel better knowing that whatever that we decide to do, you no longer have to fear losing to the market?
Yes.
That's not going to be a fear of yours. It's not going to go back down. It's
No,
only
no,
going to go
not at
up.
all. No
It's
more
only going to
fear.
go up.
Yeah.
And just so you guys know, just for strategy, what we're doing is we're rolling it over, we're checking our options, we're analyzing, right? Because we have amazing options, right? We have a 30% rollover bonus with Nationwide, and it's a fabulous opportunity. We have so many options in our company. That's why I love working for our firm, where we have options to truly help our clients. So what we did is that we set him up on his own index account. He is protected through Nationwide. He's still growing his retirement, so we don't put all our eggs in one basket. He has his IUL, which means day one protection, which was very important for him to have a permanent protection for his wife and his kids. And now to grow the retirement through the index strategies and stop losing to the market. If you can control it, then do it. So there's definitely things that we can do to help you strategize and really look at your financial plan. Thank you so much for sharing, Salida. I appreciate it.
Absolutely. Thank you.
I'm gonna call on one more person. Guys, we have amazing audience here today. And some of you are business partners, some of you are clients of ours, and some of you are just brand new people who were invited. So someone asked if I could in the chat, someone said, can I do this at 50? So we have David Correa, who is retired, right? His son is the one that actually started with this company, and the son eventually brought the dad and the mom on board. David is licensed. He is a marketing director, and David is retired. So, David, if you don't mind sharing, for older folks like yourself, 50s, 60s, whatever, can you share about your takeaway and how has these strategies helped you being a retired postal service worker?
Thank you. Yes, Odetta. Oh man. Again, yeah. when I learned about this stuff about 5 years ago, boom, I put my stuff in an annuity. I got my own IUL at 58, and as fat as I am, I still got it. And see, so even though it cost a little bit more, it was worth it. It's worth it. Just like Myra was saying, you want to, that lady wanted to leave something. And so when I leave, that's why I rolled over my annuity right now. I just rolled over another one into the nationwide. 30%, 8%. It's true. Beautiful. My IUL, right. When I pass, everybody's going to pass. When I pass away, I want my IUL money to go into my son's IUL money and my granddaughter's IUL money. That is what you call generational wealth. You leave them what a 40, 50, 100,000, 200. What they're going to do with it? Put it in the IUL, structure it, and now get their projects down the road. I'm creating my retirement for my son and granddaughter. Beautiful thing. Thank you.
I love that. Thank you, Pops. Can y'all tell he's from New York?
Wow. So you say you might be in your 50 to 60, and on one hand, yes, it might be short in terms of building cash value and having retirement money. But if you're big on leaving a legacy, well, it's life insurance and there is a death benefit, right? If you have kids and grandkids now, it's not so much about you spending the cash while you're alive, although there will be some, but not a lot. But the younger that you guys are, when we hang up on the Zoom, every one of you, if you have an IUL, you want to always have in the back of your mind, let me fund it because I have time. Let me fund it. You saw what Myra showed you. She put more money for a shorter period of time and it worked out beautiful. If you are young like me, right? This is the year, not this year, but this is the time that you want to fund more your IUL. And if you're on this call and you do not have an IUL, get in touch with the person who invited you. Everybody's situation is going to be unique. Your goals, your strategy. We don't know what you have. It's like filing tax. We got to have a one-on-one, see what your goals, see what we're working with, and we can make a recommendations, right? So please
Yeah,
get in
absolutely.
touch with us.
I have one more question. It's a very good question for Ms. Donna Smith. How do you avoid paying taxes when you take money out of the IUL compared to taking money out of the Roth? Well, first of all, the beautiful thing is that you don't avoid it. There's an actual tax code. And I'm gonna love tax codes and sharing tax codes. So let me share my screen again. This is section 7702, you guys. Everything that we've talked about, there's a tax code attached to it. So tax code 7702, it's a federal law. And what it is that it's taking into taxation, it's taking into account how do life insurance policies get taxed. So what the government's doing is they're allowing your income death benefits, right? So anything paid out, it's not taxable. And right here you'll see let me see. Any gains that accrue within the policy during the policyholder's lifetime are not taxed as income. So this is an actual tax code. There's tax code 7702A that if you want to look it up, it's literally, look, I'm literally putting IRC. IRC stands for Internal Revenue Code 7702. What is 7702? It defines what the federal government considers to be a legitimate life insurance contract, and it's used to determine how the proceeds of the policy generates are taxed. And there's a whole, and I know y'all don't want to look at it, that's why I'm the professional, but this is what I have to read for me to be knowledgeable, actual tax codes. And that's what it's talking about. It's talking about life insurance not being taxable and the cash value of it is not taxable. This is why we really have to be knowledgeable when we're talking to people as to why it's not taxable. There's a tax code, right? Just like there's a tax code for the Roth IRA, just like there's tax codes for the 401k, there's a tax code to this that teaches us, how it's not taxable, and it's not something you don't even have to do anything to it. The natural thing of what it is, it's not taxable income because it's tied to a life insurance policy, and life insurance proceeds are not taxable. So I hope that was clear. And Yes, it is the same as universal life, but better because universal life has limited growth. The average growth on a universal life policy is 3 to 4%, where in our company, we have Transamerica that guarantees 0.75, is capped at 13. And we even have options with companies like Nationwide where there's no cap on the returns. And you can get with the person that invited you on this call, and they can show you the different strategies that could help you grow your money. But this is index universal life. Index is always better than universal life because of the growth potential that it has. It's tied to an index, so it grows with the market, but it doesn't fall with the market. All right, and Ms. Dobson, you said to please explain the difference on universal and index, or did I explain it? You can unmute if you want to. I'm not sure if you mean the tax code or if you mean the difference between universal life and index universal life. So with the IUL versus the UL, I explained that, and I mean, I'm telling you, we're broker. We have options for everything. So what we do, we have so many options, and I love it because we get to learn these things so we can go and share the financial education that people need and not sell a product. So if you ever wonder, like, am I gonna sell life insurance? No, you're not gonna sell life insurance. You're gonna educate people, and then you're gonna make a decision with them, right, as an advisor to make the right solution choice for that family.
Thank you, Myra. And
All
with
right,
that
well, I
said,
think, okay, perfect. I did explain. Well, thank you guys so much. I appreciate everybody that got on tonight. I hope that I added value and that you learned something new that you didn't know before. I appreciate Odetta for inviting me, and thank you.
awesome. So guys, like I always say, please, 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 if you want to learn more about these strategies for yourself, you can become a member with our organization. As a member, you have lifetime access to learn about these strategies for yourself. Or if you also want to come on the business side and be a broker like us, please, please, please talk to the person who invited you so we can get you started with either becoming a member and getting a client, being a client, or becoming a business partner and going the fast track of getting your license, learning the stuff and teaching and educating and helping families, right? So very important. As soon as we hang up, call the person who invited you and say, hey, I want to learn more about this IUL, or I want to learn more about the business, or I just want to be a member and have access to your amazing platform and learn all the different strategies, how to grow and protect and keep your money safe. Next week, we are officially going to be in May, and we have an amazing dynamite lineup. Also, we have, well, I'm not going to say who we're going to have, but all I will say is keep coming and learning, right? Next week, Wednesday, is a new month. We're going to be in May, and don't keep this information to yourself. Share it with others. You guys are going to get the recording. You can watch the recording, but you could also share the recording. Share the recording with a friend, with a coworker, somebody at your church, I don't know, your spouse. Share the recording and then get in touch with us so we can help you put a strategy in place. And once again, thank you so much, Myra. We'll see all of you back here next week, Wednesday. It is the same link. Every week is the same link, right? You're gonna keep getting reminders, and if you can get on, great. If you cannot, that's also great, but share the information. But more importantly, let us help you with a strategy. Now that we know better, let's implement and do better. And for those of us that are business partners, we will see you guys on the other Zoom with Jonathan Marion, or your senior marketing director leadership, because it's time for us to go learn as agents so we could keep sharing and educating our families. Thank you guys so much. We'll see you here next Wednesday. Look out for the email, watch the recording, and call us so we can schedule a one-on-one this week to see how we can help you. Thank you so much, guys.
Thank you, Myra. Excellent presentation. This is Claudia Saul.
Hey, Miss Claudia.
Hi, how are you?
Thank you. I'm good. Good to see you.
Excellent presentation. Excellent. I've learned a lot.
Awesome. Guys, Miss Claudia is retired. She's in her in your 80s, right?
Yes, yes.
We don't need to have, and she's also a teacher. Well, you were a teacher. and she's an author. Listen, Miss Claudia did it all. So Miss Claudia, we may bring you on board too.
Thank you. Thank you very much.
You're welcome.
Have a good night.
Good night, y'all.